Money matters to everyone, especially when it is public money. Every citizen, a bustling city dweller, a quiet rural resident, has a stake in how their government manages its finances. They want to know that their hard-earned tax dollars are being used wisely, efficiently, for the common good. They expect fair access to essential services like healthcare, education, infrastructure. For this to happen, governments cannot simply collect and spend money without a system. They need clear, consistent, transparent rules to account for every dollar that flows in, every dollar that flows out. These rules are the bedrock of public trust and accountability, ensuring that budgets are not just numbers on a page, but a true reflection of a nation's priorities and promises. In the complex world of public finance, international standards provide this crucial framework. These are the International Public Sector Accounting Standards, IPSAS. Think of them as a universal language for government accounting, helping everyone from local municipalities to entire nations record financial activity in a comparable, easy-to-understand way. This 10-minute crash course will demystify a core concept in these standards, the critical difference between exchange and non-exchange transactions. We will explore three foundational rules: IPSAS 9, revenue from exchange transactions; IPSAS 23, revenue from non-exchange transactions; IPSAS 42, social benefits paid to citizens. Throughout, we will break down technical rules into simple, digestible concepts with everyday examples: parking permit fees, income taxes. We will show why these rules matter for the daily lives of citizens and the responsibilities of public officials. Understanding how revenue and expenses are recorded helps us be informed participants in democracy. We will finish with a concise recap of key takeaways. This is not just for accountants or finance ministers. It is for anyone who believes in good governance. When governments follow clear financial rules, a ripple effect follows. It enhances transparency and reduces opportunities for corruption and mismanagement. Before diving into the specific rules, it is essential to grasp a fundamental concept. What exactly is government revenue? In the simplest terms, revenue is the income a public entity receives from its various activities. Within IPSAS, revenue is broadly classified into two main categories: exchange revenue and non-exchange revenue. This financial inflow is the lifeblood of the public sector, funding highways, public schools, salaries of firefighters, and social safety nets. How a government recognizes, measures, and reports this income provides a true and fair view of its financial health and its capacity to serve its citizens. Good accounting practices are the cornerstone of accountability. This is where IPSAS plays a pivotal role. Designed to promote high-quality reporting across the globe, IPSAS enables entities to speak the same financial language. Citizens, investors, and oversight bodies can compare performance and hold entities accountable. Exchange revenue arises when government provides goods or services for payment of approximately equal value. Non-exchange revenue arises when it receives value without providing approximately equal value in return. This distinction dictates when revenue is recorded and how it is measured, central to budgeting and financial planning. Government can act like a business selling services and also exercise sovereign power to levy taxes and receive transfers. Each needs a different accounting approach. We will dissect each category, starting with the more straightforward world of exchange transactions. Our first stop is IPSAS 9, revenue from exchange transactions. An exchange transaction is a reciprocal arrangement, a deal where two parties trade items of roughly equivalent value. A public entity provides specific goods or services to an individual, a business, or another entity, and receives resources, typically cash, of similar fair value. The payment is not a general contribution. It is a price paid for a specific benefit. Common scenarios: building permit fees, university tuition, utility sales, and national park entrance fees. In each case, there is a clear performance obligation on the government entity. Recognize revenue when it is probable that future economic benefits or service potential will flow to the entity, and the amount can be measured reliably. For goods, when risks and rewards of ownership transfer. For services, by reference to the stage of completion, as the service is performed over time. Measure at fair value of consideration. Adjust for trade discounts, volume rebates, and expected returns. If payment is deferred, record a receivable. These rules ensure statements present a prudent and accurate picture of earned income, recognizing what is earned when it is earned, at an amount expected to be received. Imagine a city-operated transit system. When a passenger buys a single-ride ticket for $2, the city has received cash but not yet earned the revenue. Revenue is earned when the passenger actually takes the bus ride, when the service is provided. At that point, the $2 can be recorded as revenue for that period. A government-owned fitness center sells a $600 annual membership. It cannot recognize the full amount in January. Under IPSAS 9, recognize revenue systematically over the service period, $50 each month using straight-line recognition. A publishing office sells 100 legal code books at $50 each. If risks and rewards transfer on shipment October 31st, recognize $5,000 on October 31st, even if cash is due in 30 days. The key event is the transfer of control, not the receipt of cash. Providing a single bus ride, granting year-long access, delivering a shipment, revenue is earned when the government substantially completes its side of the bargain. This prevents overstating income by booking revenue before it has been legitimately earned through performance. Now we shift to the often larger source of funding, non-exchange transactions governed by IPSAS 23. Unlike quid pro quo exchanges, a non-exchange transaction occurs when a government receives resources without directly giving approximately equal value in return. This is the domain of sovereign powers and public support, taxes, grants, donations, and fines. When a citizen pays income tax, they do not receive a specific measurable service equal to the payment. The funds support services that benefit society as a whole. A grant to combat a public health crisis provides funds without a commercial service sold back to the donor. IPSAS 23 applies when resources are obtained through taxing authority or through transfers where no direct equivalent value is provided back. Income taxes, property taxes, VAT, GST, customs duties, all classic non-exchange revenue. Intergovernmental grants too. Because there is no performance obligation, IPSAS 23 uses different recognition rules. Recognize an asset when control of resources is gained, and recognize revenue at the same time unless a specific condition is attached. A condition requires returning resources if not used as specified. This significantly affects timing of revenue recognition. For tax revenue, recognize when the taxable event occurs, the amount can be reliably measured and collection is probable. Income tax, earning assessable income. Property tax, ownership on the assessment date. Recognize in the period the event occurs, not when cash is received. A store sells a product on December 20th. That sale is the taxable event. Recognize VAT in December, even if cash remits in January. This matches revenue to activity and gives a more accurate picture. If a transfer has conditions, record cash and a liability, deferred revenue. Recognize revenue only as conditions are satisfied. Grant to build a hospital. Recognize revenue as construction costs are incurred. Foreign donor provides $10,000 with strict use conditions. On receipt, record $10,000 cash and $10,000 liability. Spend $2,000 on vaccines in Q1. Recognize $2,000 revenue and reduce liability to $8,000. This ensures revenue is only booked when donor conditions are met, promoting accountability and responsible use of funds. We have covered how revenue is recognized for exchanges and non-exchanges. Now we turn to the other side, how governments recognize expenses for social benefits under IPSAS 42. IPSAS 42 introduces guidance and defines social benefits, provided in cash or in kind to specific individuals and households to mitigate social risks and address needs. These programs form the backbone of the welfare state. Old age pensions, unemployment benefits, disability allowances, and child support. IPSAS 42 applies when a public entity provides social benefits directly to eligible beneficiaries, non-exchange by nature. These programs are among the largest obligations. Accurate accounting of expenses and liabilities is essential for planning and transparency. Recognize expense and liability when a present obligation exists. When an individual meets all eligibility criteria and the government has little or no discretion to avoid payment. Record the expense in the period the eligibility event occurs, not only when cash is paid. State pension entitlement at age 65. For a 68-year-old, recognize the current month's pension expense in the same month. Measure by the best estimate to settle the obligation at the reporting date, usually the legislated benefit amount. This ensures reports reflect the true cost of social programs in real time. You might wonder why IPSAS 9, 23, and 42 matter. The answer is simple. They are the foundation of transparency, accountability, and trust. Consistent reporting empowers citizens. Clear statements help journalists, civil society, and taxpayers scrutinize collection and spending. Transparency deters corruption and mismanagement. Officials make better decisions. Finance ministers with realistic revenue under IPSAS 23, city managers planning exchange cash flows under IPSAS 9, and administrators forecasting social liabilities under IPSAS 42. Adopting international standards enables comparability, from Toronto to South Africa to the EU, attracting investment and lowering borrowing costs. When citizens understand finances, trust grows, the glue that holds democracies together and fuels participation and resilience. IPSAS 9. Recognize exchange revenue when performance is delivered. IPSAS 23. Recognize non-exchange revenue at the taxable event or as transfer conditions are satisfied. IPSAS 42. Recognize social benefit expenses when eligibility creates a present obligation. Together, IPSAS 9, 23, and 42 connect the taxes people pay to the support they receive, with timing and measurement that reflect reality. As you pay a fee, file taxes, or hear a budget debate, remember the simple logic that underpins it all. Clear rules do not just make for good accounting, they make for good government.